Have you ever wondered how elections impact the stock market? It's a fascinating correlation that tends to stir up quite the conversation in the financial world. The relationship between elections and stock markets primarily revolves around uncertainty and political transitions. During an election year, the market often experiences volatility due to the unpredictability of the election outcome and the potential for new policies. Every political party has its own economic agenda, which invariably influences the stock market. For instance, sectors like pharma and auto might thrive under one regime, while IT and metals might underperform. This is because different political parties implement changes that lead to favorable results in their preferred sectors, sometimes obstructing others. However, it's essential to remember that stock markets are not solely driven by political factors. They are complex systems influenced by a myriad of domestic and global events. Elections simply introduce an additional layer of uncertainty, making the markets more susceptible to short-term fluctuations. Now that you understand the general impact of elections on the stock market, let's delve deeper into some historical examples. History has shown us that political transitions can lead to significant market volatility. Let's take a journey back to some key moments in time to see this in action. In 1989, India saw a change in government, and with that came an increase in market volatility and economic fluctuations. The situation was further exacerbated in 1991 with the tragic assassination of Prime Minister Rajiv Gandhi. The stock market reacted, as it often does in times of great uncertainty, with heightened volatility. But then came a ray of light. The National Democratic Alliance, or the NDA, came into power in 1999. This transition brought much-needed stability to the market, leading to positive trends and an influx of foreign investment. Fast forward to 2004, and the market took a hit once again. After the elections that year, the market lost 15% of its value. However, this decline didn't last forever. The market rebounded, and we saw a bull rally continuing until 2007. The second term of the United Progressive Alliance government was marked by scams and a decline in investor confidence, resulting in reduced investments and a slowdown in economic growth. But the stock market is nothing if not resilient. In 2014, the return of the NDA to power boosted investor sentiment and led to a more stable trading environment. Most recently, in 2019, the election resulted in record highs in key stock indices. This was largely due to expectations of economic reforms and policy continuity under the BJP-led government. However, both external and internal factors meant that this growth wasn't fully realized. As we have seen, the impact of elections on the stock market can vary greatly depending on a variety of factors. From political changes to economic policies, the stock market is a complex beast that responds in kind to the world around it. The long-term effect of elections on the stock market is largely determined by the economic policies implemented by the ruling party. You see, it's all about stability and certainty. When a government introduces positive economic policies and maintains political stability, it's like a green signal for the stock market. Prices tend to increase and the market thrives. On the other hand, uncertainty can be a bit of a party crasher. Vague promises, policy changes, and political transitions can lead to decreases in stock prices. It's like a cloudy day on the stock market beach. But here's the silver lining. Regardless of the party in power, India's economy generally continues its pro-growth trajectory. It's like a sturdy ship sailing steadily, weathering the occasional storms. The economy emphasizes infrastructure, productivity-boosting reforms, and market-driven economic policies. It's all about strengthening the economy's resistance to political changes. So, while elections can bring short-term volatility to the stock market, the long-term trends are more dependent on the economic policies of the ruling party. Let's bring these concepts to life with some actual figures and tables. On average, the month leading up to elections sees a return of 6%, while the year prior boasts an impressive 29.1% return. Now, let's consider some projections. If the current administration secures a commanding win, we could see a market gain ranging from 0 to 5% in the subsequent 3 months. On the flip side, if the BJP were to lose in 2024, which has a 10% probability, the market might correct itself by a hefty 25%. But let's not get lost in the immediate aftermath of elections. The long-term trends are equally crucial. Since 1980, there have been 11 changes in the government. Yet, the economy has steadily grown with an average real GDP growth of 6.2%. The Sensex, a benchmark index of the Bombay Stock Exchange, has given an annual compound growth rate of 15.5% during the same period. As you can see, the numbers clearly illustrate the impact of elections on the stock market.